Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Onconova Therapeutics stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Onconova Therapeutics is a clinical stage biopharmaceutical company focused on discovering and developing products for cancer patients. The company is headquartered in Newton, Pennsylvania and was founded in 1998. It went public in 2013 and trades on the Nasdaq and Deutsche Börse. This month, it announced that the first patient has been dosed in the phase 1 clinical trial of its multi-kinase inhibitor. This helps decrease tumor growth. The trial is expected to include 3 US cities that will enroll patients with advanced cancer, including metastatic breast cancer patients. Let's get started with the model. This is a micro-cap company, 114 million market cap. They're trading at $7.20 a share, and they have 16 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is the sales for the company, which is pretty small. It peaked in 2019 at $2 million. This is the company's income statement. The top line is the revenue, the sales. Below that is their operating expenses. Revenue minus operating expenses gives you your operating income, which is negative every year since they have a small amount of sales. Below that is other income and expenses, which are usually asset sales or asset impairments. Then the bottom line of the income statement is their net income, which is pretty small each year, since they have yet to develop a drug that has been approved by the FDA. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. And they have a small amount of CapEx each year. Operating cash flow minus CapEx give you your free cash flow. And of course, they have negative free cash flow each year. So to fund their business, they're issuing capital stock every year. They issued 35 million in 2018, then 22 million, then 9 million. Every time a company issues capital stock, that increases the shares outstanding, making your shares less valuable. Let's look at the capital structure. $37 million of equity and no debt. They're 100% equity, 0% debt. And I gave them a really high WACC due to the risk of 19%. The higher the WACC, the lower the estimated stock price will be. And this is the discount rate we're going to apply to the future cash flows. I estimated 7 years of future free cash flows. I also estimated a terminal value, which is all cash flows past year 7, that's $1 billion. I discounted those numbers back to today using the weighted average cost of capital. I get a value of the company of $379 million. I divide that by 16 million shares. And we get a calculated stock price of $24. They're trading at $7.20, so they're trading at a 70% discount. It is a strong buy according to the model. It is a risky stock because they need to continue getting equity financing every year to fund their business. If the capital markets freeze up and they can't get financing, they may be forced to shut down. But if they continue getting financing and develop popular drugs, they can grow their business. My projection is they'll have $1.5 billion of revenue by 2027 if their drugs are successful, and they'll convert $170 million of that into free cash flow. That's of course a guess. Anything can happen, but that's my estimation. 3 analysts priced this stock and the average price target was $46. The low was $32, the high was $60. This top chart is the stock price since it started trading. It's really hard to tell how the stock has been doing because of so many reverse stock splits. It makes it look like the stock was trading over $70,000 a share. Of course, it was never that high. They just have to do reverse stock splits so they stay above $1 and not get delisted. Because if they get delisted, they're going to have a hard time raising capital and getting funding for their business. This is the stock price in the last year. So it looks like it peaked at about $25 a share. So you could have made a lot of money if you bought the stock down here and sold up here. Then it came crashing down the past few months as people were taking in their gains. They have a beta of 1.62, so the stock moves a little more than 1.5 times the market. It's a little volatile. The stock has gone up 21% in the past 52 weeks, while the S&P 500 went up 38%. The 52-week low was $3, the high was $29. And the stock is trading below its 50-day and 200-day moving average, so it seems to be on a downtrend. This is a pretty liquid stock. 1.5 million to 5.5 million shares are traded each day. Of the 16 million shares outstanding, 15 million are on float, 23% are held by institutions, and almost 2% of the shares are shorted. In the past year, this stock has gone up 23%, while its industry went up 18% and the market went up 47%. But in the past 3 years and 5 years, this stock has lost over 90% of its value. That's mainly due to all the reverse stock splits, while its industry and the market have gone up a lot. In the past 5 years, their annual earnings decreased 7%, while its industry increased 21% and the market increased 12%. In the past year, their earnings decreased 31%, its industry increased 1%, and the market increased 20%. If you invested $10,000 into this company when it IPO'd, you would have been up right away to over $12,000. But if you held on, you would have been under $2. That's almost a 100% loss. That just shows you how much reverse stock splits can dilute your stock value. The biggest shareholder is Lincoln Park at 5.7%, then Vanguard, Armistice Capital, BlackRock, and Renaissance Technologies. Let's look at their financial ratios. The average PE in the market's 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so we can't look at the PE. They have a really bad price to sales ratio of 484 because they have such low sales relative to their market cap. That means investors are paying $484 for $1 revenue. Their price to book is really good at 3.1. That's a little better than the market median. They have negative net income, so they have negative ROE. They have a really high current ratio because they did a recent capital raise in the first quarter of this year. So they have $48 million of cash on their balance sheet. So they are well funded. Even though they had negative $23 million of free cash flow, they have $41 million of working capital. It looks like they should have enough cash to get through this year without doing another capital raise. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 14 companies in the same industry as ONTX, and if ONTX has number in red, they're worse than the average. If they have number in blue, they're better than the average. So they're worse in PE and price to sales. They are doing better in price to book. They do have a high current ratio. They have a bad ROE. They have no debt and a really small market cap of only 114 million. Average is 20 billion. To summarize, I have them trading at a 70% discount, but it is a really risky stock because the company is not generating any money. It's relying on equity financing, which is diluting the shareholders in order to run the business each year. They seem to be developing some really exciting drugs that may change the world, but of course, nobody really knows if they're going to be successful until they are. I ranked their free cash flows 1 out of 10, their revenue 1 out of 10, and their ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on a link in the description below. Thanks for watching.